Hello, everyone, and welcome to today's webinar about leveraging complex assets for smarter charitable giving. With the unpredictability of legislative changes on the horizon, now is a critical time to evaluate your client's charitable strategy. Given recent market conditions, your client may have long-term appreciated assets ripe for donating. Today, we'll explore this tax-savvy opportunity and provide actionable next steps for you and your clients. For those who attend the live session for at least 50 minutes, we will submit your attendance directly to the CFP board and IWI with the information you provided with registration. No further action is required on your part. I'm Jim Carpenter, Vice President and Charitable Planning Consultant at Fidelity Charitable, an independent public charity that has helped donors support more than 328,000 nonprofit organizations in excess of $52 billion in grants. I work with advisors in the Great Lakes and Mid-Atlantic regions to enhance their understanding of Fidelity Charitable's Donor Advised Fund program and discuss creative and impactful ways to incorporate charitable giving into holistic wealth management. Let me introduce you to my co-presenters, Lori Roach and Leon Lebrecq. My colleague, Lori Roach, is a director in the Complex Asset Group here at Fidelity Charitable. Lori brings significant knowledge and technical expertise to donors who wish to contribute sophisticated assets, such as privately held business interests, to charities. Ms. Roach works directly with donors, their advisors, and corporate and business lawyers to facilitate charitable contributions to these assets to achieve the most favorable tax treatment with the greatest charitable impact. And we're joined by our friend Leon Lebrecq. Leon is Chief Growth Officer with Sequoia Financial Group, and he focuses on advising high net worth families on investment strategy, financial planning, and generational wealth transfer. Leon has been a financial advisor for over 40 years and is a practicing attorney, CPA, CFP, NCFA, and CAP. This experience allows him to bring a unique, multi-dimensional approach to helping others fully understand their financial lives. We want to thank everyone for making time to be here today. Let's dive right in. Jumping right in, let's take a quick back look at the current landscape in philanthropy. What goes on and what are we talking about today? You can see on this chart, we're updated for the results that came in on the Giving USA report just last week. It turns out that in 2020, which was quite a year around the country and around the world, in 2020, Americans gave $471 billion to their favorite charities, a significant improvement or increase over the $450 billion in the previous year. So it was a big year. And for those of you doing the math at home, you'll recognize that that is about 2.3% of GDP, also a significant increase over previous years. On the other side of the slide, you can see that of that phenomenal number, 69% of that giving, so call that $320 billion, give or take, is individuals making direct gifts to their favorite charities. Factor into that many of the foundation giving is individual families, and the bequests are certainly individual families. That $470 billion last year, right around 90% of that is individuals making selections to the charities that are important to them. Let's take a look at why we talk about philanthropy in general. In the financial services business, we talk about this quite a bit. Somewhere around 90% of high net worth households are making charitable contributions. And of those, more than 70% agree with us that discussing philanthropy with their financial is important, and it's important early and often in the relationship. Leon, can you talk a little bit about Sequoia's clients and how you guys address charitable planning?
I'd love to, Jim. Our clients are very interested in charitable giving. I'd say it's an integral part of all our conversations with our clients, and it actually falls into two categories. Usually we start out with the charitable conversation and they go, well, you know, I'm not that charitable. And then I usually get in, put on my tax hat and go, hey, you realize that there's a double whammy here that we can get around. We can get around capital gain taxes and we can get an ordinary income deduction. And if you go into some of the more exotic things, we can even generate income. As soon as we start getting into that, the tone starts to change and people get surprised at how charitable they really are starting to think. And so we're seeing in that fashion. I also find that it's great for intergenerational wealth transfers. I can say to the client, look, let's talk about this. What about mom and dad? What about your kids? You know, what about your adult kids? How does that work? So I see there's an intergenerational picture here, and it's bringing the family together. And you're saying, what does your family want to do? What is the legacy? What kind of legacy do you want to leave as a family? And I've picked up multi-generational clients that way. Start with one, you know, I might start with an executive, and then next thing you know, I'm talking to their mom or dad or both, and then I'm talking to their adult kids, and pretty soon, you know, we're doing a family plan in terms of charitable contributions, and it's a huge thing, and it's really, and you know, I think it's an essential part of a good financial plan. I'm just keen on it, Jim.
That's great. Thanks, Leon. So let's take a quick second just for the background on who we are at Fidelity Charitable. As I mentioned earlier, we're an independent 501c3 public charity established in 1991. We did have our 30th birthday just a couple of weeks ago. And what we do exclusively is sponsor donor advised funds. So we've supported through our donor advised funds roughly 328,000 different public charities. We've granted out over that trailing 30 years a little over $51 billion to not-for-profits. Those numbers make us the largest grant-making charity in the United States. We're quite proud of that, and we expect to continue. As I mentioned, what we do is the donor advised fund. I'm not going to spend a lot of time on it today, but it breaks into these three pieces. Making your tax-deductible contribution. The donor advised fund allows you and your financial advisor and the clients to time their charitable giving to pick the right asset at the right time at the right price for their personal tax planning and portfolio work. And then once that gift is in the donor advised fund, the record keeping is simple. It's a single receipt, getting grants out the door, et cetera, is all quite easy to operate. The second slot, the contributions into your donor advised fund will most likely be invested for growth. Over the years, our portfolio has expanded by a little over $15 billion of investment earnings, much of which has been given away already, more to come. The third section is granting. We will make grants out to IRS qualified public charities, 501c3 public charities, religious organizations, and government entities. It's quite easy to do. We have layers of online capabilities. It works on your phone. It's a great way, as Leon mentioned, to involve the family in conversations around what organizations we should support and why. And the last one, many of our families like the option to make their gifts anonymously to support charities that they love, but not necessarily take the credit. So the donor advised fund is all about give, grow, and grant.
So, you know, Jim, in our shop, I have frequently involved the kids in the granting process too. So I've recommended to the parents, look, why don't you let your kids use some of this donor advised fund? Why don't you let them pick a charity that they like? And that's usually very well received by the client. The client likes it, and they go, and then the kids are starting to think that way, and it's building that idea of a legacy inside, you know, the family. It's a family generational legacy. So yeah, I think that's important.
That's just great. Yeah, and we do actually on the electronic system have a way to directly support and facilitate that. So let's get right into the meat of this. We have our CPA, CFA, JD, CAP on the line with us to talk about taxable benefits. So let's just jump right in, and we'll take a quick look at what the current state is, and then we'll spend a little time discussing on what the future might hold. For 2021, let's address the current state of tax incentive for charitable gifts. For itemizers that make cash gifts to public charities, special provision in the CARES Act just for 20 and 21, a special provision that allows a cash gift to public charities a tax deduction as much as 100% of AGI. Your most generous clients could zero out on their tax return this year by moving an equivalent to 100% of AGI to public charities. But if they want to use some sort of planning tool or organization, like a supporting organization or a donor advised fund, they're still going to be limited to 60% of AGI for cash contributions. And if they're using a private foundation, they are going to be limited to 30% of AGI for cash contributions. Speak with your CPA for direct tax advice. Some combination is available here. For long-term appreciated securities, say public securities in your portfolio, those are currently deductible as gifts to public charities or operating foundations to 30% of AGI, or to a private foundation to 20% of AGI. Once again, seek good tax advice because you can stack these up to maximize your charitable giving. Over on the capital gains side of the equation, short-term appreciated securities generally don't make particularly good gifts. The tax deduction is generally limited to the cost basis in those securities, and you're not really going to be able to transfer the capital gains over to the charity. Long-term appreciated securities, on the other hand, as you know, if you liquidate, you're going to be taxed at 15 or 20% of capital gains taxes. For high income, there's a bonus Medicare surtax in some cases. But the deduction is going to be the fair market value of the securities, the market value of those securities at the date of the gift. So the deduction is going to include what would have been paid as capital gains. Leon, you want to chime in here a little bit?
Oh yeah, there's so many good things here. First of all, if you blow past the limit, you can carry them over. So remember that. It's not like you use it or lose it. You get to use it and keep it. So I've had clients make some appreciated security gifts and then keep the basis going and then done a Roth conversion or something in a future date. So that works out really well. We've also seen situations where we'll do the stacking. We'll stack a cash gift to, if we know we're going to give to a public charity, we'll stack that with a donor advised fund. We'll stack that with appreciated securities. So the stacking idea, Jim, right on board. And then on cap gains, because I'm an investment nerd and a tax nerd, we've actually hedged to keep the long-term gain period going. So we'll actually put a either cashless collar or put a hedge on a piece of security on a security that's really highly appreciated. Stock shot up, client had it for 10 months. We'll throw a 2-month hedge on to get it to the 1-year period, but we'll take away all the market risk. Small amount of insurance costs. Do that through your Fidelity account first, and then make the gift to Fidelity Charitable. So there's a lot here, and there's a lot to be talked about. And actually, what scares me is what might happen. There's more. But what could be worse?
Look, there's more.
Yeah.
Let's talk about. Let's run through sort of what the potential changes are. Leon, why don't you take this one?
Yeah, this is I do a lot on this. I write a column for Forbes on taxes, and I call this the Godzilla coming out of the water. There's 35 tax bills at last count. One of them is a tax cut, and the other 34 are tax increases. So under the current law, you get a deduction, and it saves you a tax on the marginal rate. There's a potential they're throwing around putting the P's back in, the P's limitation back in, which would be a limitation, and restoring the P's for incomes over $400,000. That's not in the current green book, but I keep hearing that noise out of DC. The one that gets scarier is the long-term capital gains rate. Right now, it's 20% plus a 3.8% NIT. If you have AGI over $1 million, it would be 39.6% plus a 3.8% NIT, 43.4. My little math brain says it's a 98% tax increase, and it certainly makes the gift a lot more attractive. And then now Godzilla stomping his way through our planning modes is this, the getting rid of the step up in basis. If they put a carryover basis in play, the American Family Plan basically says that death is a transaction. You would have carryover basis and have capital gains upon death. It certainly is giving rise to a lot of conversations we're having right now. Of course, now your mileage may vary, and this is not law yet. So this is, law planning is safe when used as directed. But if we get carryover basis in here, Jim and Lori, this will just change the whole game completely. We'll be doing a lot of things with charitable remainder trusts and a whole variety of others. And then there's an estate tax exemption being floated around as well. Bernie Sanders and Elizabeth Warren had proposed lowering it immediately to $3.5 million per person and knocking the rate up to 45%. Do we think at Sequoia all these things are going to happen? We're not thinking all of those will, or some of those will. Right now, it looks like we're going to get an infrastructure bill without any tax changes. So this would be in a reconciliation bill near the end of the year. But there's some scary stuff here, kids, and this is things that we need to be looking at. And definitely clients are thinking about it. They're reading articles. They're being, it's part of the overall charitable planning. And suddenly the ingredient of charitable planning becomes way more potent, way more powerful for us. And it's one of those things that clients want to hear about and want to know about. Ignore this at your own risk. So tell us about the benefit of donating. You know, a lot of people donate cash. Jim, why? They should be donating super money. Why are they donating cash? What's wrong with these people? Why aren't they listening?
You know, it's hard to say, but that is the default position. So 80% of donors, and this is a Fidelity charitable donor survey, you know, lots of donors have appreciated assets. They just don't use them. They just think in terms of their philanthropy or their charity, their charitable giving, like the rest of their expenditures. And they want to use money because that's how things get spent, right? And so, but the answer is donors are so much better off if they use appreciated securities. About 20% of donors have. It's a lot higher percentage here at Fidelity Charitable, more like 65%, because of course we work with the financial advisor community. But let's just do a quick reminder and run through on the math of using appreciated securities instead of money for a charitable gift. Here's our donor. She's a top bracket taxpayer at 37% federal plus the Medicare, NIT, et cetera. She has a call from her favorite charity. They're having an emergency. They need $50,000. She looks in her portfolio, sees a $50,000 position. In this example, it has $30,000 of unrealized gains in the position. And left to her own devices, she's going to go down that left side column and convert the $50,000 position into what people think of as grantable form. She's going to liquidate the position, convert it to cash. That's going to trigger taxes on the embedded gains. You can run down this. She starts with 50. She pays 71.40 in capital gains. So really her net charitable donation is 42.8 for a federal income tax savings of $15,858, assuming 38%. With good advice, the power of appreciated securities is quite clear. If she journaled those securities directly to the public charity, say her donor advised fund sponsor, the charity liquidates the securities at their tax bracket, which in that context is 0. The net charitable donation is all $50,000, and the income tax savings is not 15.8, but 18.5. So the math is the client saves $3,000 in taxes. The charity has $7,000 more in cash in their account, and Uncle Sam has funded both of those increases. So the power of using appreciated securities is just untouchable. And if capital gains tax rates go up and income tax rates go up, this leverage is going to be even more dramatic.
It's like super dollars, Jim. It's like having a super dollar. It's having a dollar that's bigger than a dollar. And you know, I've had clients that have had demutualized, insurance companies that have 0 basis, and they've held them for longer than a year. I go, there you go. You're going to either, we can get out of the capital gain tax and get the ordinary income deduction, and you can always go buy it back in a Roth IRA or something. It's okay. It's perfectly fine to do this. So I just think there's an awful lot there. And I think our viewers should not ignore the opportunity of NUA. I know we're going to talk about that when we talk about concentrated positions in companies, but there's an automatically appreciated asset that comes out of a 401k plan. You get an ordinary income tax deduction, you get a capital gain deduction, and you get an ordinary income deduction. Triple bang. It's like really, really cool. So I like super money, and once I tell clients this, they go, wow, that's a great idea. By the way, I usually tell mine, go give the charity $7 grand more. We just saved you $7 grand. Go give them some more money.
There you go. There you go. Well, let's talk about some really powerful charitable giving. We talked about cash and cash equivalents. That's what most people do because they don't have the right advice. Appreciated securities we just looked at, particularly powerful. But in many families' overall wealth portfolio, a significant amount of their wealth is tied up in complex or not publicly traded assets. That's really the heart of today's presentation. My great associate, Lori Roach, is going to talk about the complex asset world, what that looks like for us, and how the donors and the charities think about this kind of giving. Lori, I'm going to hand it over to you.
Thanks, Jim. And thanks, Leon, for making the case for us. This is really good information for everyone. My name is Lori Roach. I work in the Complex Asset Group at Fidelity Charitable. And as Jim mentioned earlier, and I think several times, highly appreciated assets are the golden standard for giving. And what most people don't realize is that while 80% of the people who give to charity use cash, in addition to that research, if you look inside the portfolio, 34% of donors have in their portfolios not just highly appreciated assets, but the most highly appreciated assets are usually in the form of privately held securities, or what we call as complex assets. So if you really dig into your clients' portfolios, you will find these assets, and because these assets are usually so highly appreciated, they are usually the best assets to give. So this is a list of the types of assets that we at Fidelity Charitable review for contributions to the DAF. We look at private company stock, S Corp, C Corp stock. Obviously, we look at any kind of cryptocurrency, Bitcoin being something that's been extremely popular lately, private equity interests, restricted stock, insurance interests, some alternative investments. These are all things that we review on a day-to-day basis as contributions to individual giving accounts. They can convert these assets into cash for charitable giving. I would say the most popular assets that people give are in the area of private company stock, S Corp, C Corp, and restricted stock. And then we also see a lot of private equity interests and LLC interests. So those are the types of things that we look at. And sometimes people will ask, like, why complex assets? Why not just give my publicly traded, asset that's highly appreciated? And certainly that is a great asset to give. But oftentimes it's really important to look for those complex assets in a client's portfolio because they are going to most likely be the most highly appreciated asset. Oftentimes people that own these types of assets are founders of companies. They got in really early as an entrepreneur or as an investor, and they have zero cost basis in these things. So these are going to be, most times, are going to be the lowest cost basis, highly appreciated securities if you can find them in the portfolio. Obviously, the fair market value tax deduction is the same with publicly traded versus privately held securities. However, oftentimes you're going to find that these are the people who are going to be in real need of tax deduction, because if you own these types of assets, it's very likely you're going to run into a high income year where either you're going to be experiencing the sale of your company or all of your restricted stock awards are going to vest at once, those types of things. And so the fair market value deduction becomes invaluable for these people. And as Leon and Jim mentioned earlier, it's just going to become more and more valuable as we see tax changes maybe come through in the next year or so. And, same thing with capital gains. I mean, capital gains rates go up the way we think they might using these highly appreciated assets, where the capital gains are going to be the highest, are going to be the most valuable assets to give. Another thing to think about is people who own these types of assets, oftentimes they're concentrated in these assets. This is where most of their wealth lies. And if they're experiencing a liquidity opportunity, this allows giving part of those, not only gives you the tax deduction and the avoidance of capital gains, but allows you to start to sort of diversify what you own, so you're not concentrated into one area. And these are really great things for if you are working with a client. These are the assets to look for in their portfolio.
Lori, we've done it. Your team worked with us on several of these. It's been a remarkable, your team. By the way, kudos to your team. You guys are great and really can do this and do a great job. I mean, we've had so many liquidity events coming up this year. It's like the private equity people have, somehow turned on a Xerox machine that's printing money, and they're off buying everything in sight for the highest multiples I've seen. And, showing a client that they can get a $500,000 tax deduction that'll offset some of their other income and allow them to have long-term charitable gains. I mean, Jim, you and I facilitated last year a $2 million gift to a Fidelity donor advised fund account, and then and then others. And I've been, of course, a client myself. So it's really amazing when you get a business owner getting ready to do a liquidity event. You can take that liquidity event and get a tax savings immediately. I mean, literally right up until the date of the transaction. And of course, Lori hates me saying that, but right up until we can call her on Friday and say, hey, Lori,
a little bit more time than that, but that's fine.
Can we do this by tomorrow, please? Because the check's tomorrow. But it's a remarkable thing. A closely held business owner, huge opportunity. And again, this goes to that generational wealth. You're now participating with the Gen 1, the Gen 2, and maybe the Gen 0 as well.
Yeah, and we certainly like to be able to help a lot of folks when they're in these positions and they're about to experience these enormous liquidity events. They're obviously very excited. This is a great time for them. But the tax planning becomes, rather a bear, and so having this as an option to plan around and to sort of help with that tax bill that might be coming on the other end of their liquidity event is oftentimes a relief, and it's something that I really enjoy helping people find.
I'm with you.
So just to go over a little bit about, these are the things that we look at when we get a call from a donor or from a donor and an advisor. What are the things that we as a charity are going to look at when we're considering whether or not we can accept an asset as a contribution? And this is generally going to be the same thing across any sort of charity or donor advised fund. These are the types of things that we're going to be looking at. I'll walk through these, but the main point to realize is that that's the benefit of using somebody like a DAF, because you don't need to know these stuff inside and out. We know this stuff inside and out. What you need to be able to do is identify where the most highly efficient assets are to give, which we've covered. Those are the highly appreciated, long-term held assets. But we can help by at least giving you an idea of what are the questions you want to be talking to your donor about if you find these types of assets in their portfolio. So the first thing we're going to look at is transferability. And so we always will be asking the donor to send us some of the governing documents associated with the asset that they want to give. We look at that for two reasons. First, we're going to look and make sure that the asset can be transferred under the terms of the governing documents. And then we're also going to look at the terms of the governing documents because effectively what happens when the gift is made is we will become a shareholder, or we will become a member of the limited partnership or the LLC for a short period of time, hopefully, until it's liquidated. And so we need to know what are the terms and conditions, what are the rules of the road while we are in ownership of that asset. So that's the purpose of asking for those documents. We're going to ask for, if it's, bylaws, articles of incorporation, shareholder agreements, any kind of financials that the donor may have about the entity, whether it's a 409A or audited financials, unaudited financials, just so we can get a sense of the value of the asset. If it's a partnership or a pass-through entity, we'd like to see K1. And those are the types of due diligence documents we're going to be looking at. After we've done that, we will reach out to counsel, and we will usually ask the donor for a name and contact information for counsel who we can work with to transfer the asset from the donor's name into our name. We have templated forms we can provide counsel. We try to keep the legal fees as low as possible for the donor. So if we give them templates, that hopefully counsel isn't putting up too many hours on that. And we also talk to counsel about what our transactional considerations will be if and when we're a holder. So as I said, effectively, we'll be a holder of the shares or of the membership interests. And when the third party comes in to buy those, whether it's an outside investor or a third party buying the company, there's going to be transaction documentation, and they're going to be looking for certain reps and warranties and indemnification provisions. As you can imagine, as a charity, we can't always make the same reps and warranties and indemnification claims or reps that other shareholders would make. So we talk about those things with counsel early on so that they are able to negotiate those terms into the transaction documentation, so that everyone is aware that there'll be a charitable holder, so we don't become a fly in the ointment when the liquidity event comes about. So that's sort of the first part of our due diligence, is working with counsel, looking at the governing documents. We always have a conversation about liquidity and timing with the donor. So this is something that you would want to talk, once you identify that asset, you want to talk to them about, well, is there going to be an opportunity for the charity to liquidate this in the near future? Whether it's a hedge fund that someone owns that has quarterly redemption opportunities, or it is a founder who is going to be selling the company and he and his other shareholders are going to be selling along, they can sell along with Fidelity Charitable. You want to find out what that liquidity opportunity is, because from the charity's perspective, the purpose of taking in these assets is solely to convert it to cash so that it can go into the giving account and the donor can make grants out. So we want to make sure that we don't want to holding assets for more than 6 months to a year being on the far end of the spectrum. We really want to make sure that liquidity opportunity is there. The next important thing to remember is timing. So you want to make sure that you identify opportunities early, because if the donor were to gift the asset after they've already sort of signed a purchase and sale agreement or agreed in a binding obligation to sell the asset, that's not going to be considered a completed gift from the IRS's perspective. They call that anticipatory assignment of income, which essentially means if you've already sort of agreed to sell your shares or your interest in your partnership to someone else, the income is already vested in you, and you can't sort of give away the tax liability associated with that, and it's just too late. So you want to make sure, that's another reason why you want to have these conversations with clients on a regular basis so that you know where those assets are and what's happening in their lives, and is there a liquidity opportunity coming up so you can be out in front of it. It's really never too early to have the conversation, but it very much can be too late. So you want to keep that in mind. Valuation. One of the things that comes as a surprise to folks who are giving privately held assets to charity is that the fair market value that the IRS is going to use for purposes of the deduction is going to be based on, and has to be based on, an independent third-party appraisal. So your donor is going to have to get an appraisal for the portion of the asset that they're going to be giving to the charity. They don't need to have that before they make the gift, but they will need to have it in time to file their taxes the following year and claim the deduction. And those appraisals can be discounted for things like lack of marketability and minority share interest. It's often not going to be a one-for-one correlation between, the fair market value appraisal and the price that the asset sells for in the liquidity event. That's sort of the reason the IRS has that in place, right? But there are ways to sort of minimize those types of discounts. If you're doing an appraisal around the same time that there's LOIs out there and there's a liquidity opportunity right around the corner, presumably the discounting for lack of marketability are going to be lower. One of the things I run into all the time is I talk to a donor and they start to understand the benefits of making a gift before their liquidity opportunity, and they tell all their friends. And then all the other members and shareholders jump in, and then they can share the cost of the appraisal. So that makes that something that minimizes the cost associated with making a gift. But it is something that comes to as a surprise to people, so it's something you might want to talk to donors about or your clients. Finally, we'll look at risk. There's certain types of businesses and assets that we can't take. The thing that comes to mind the most is companies that are in the business of distributing or selling marijuana products or marijuana paraphernalia. Because it's illegal at the federal level, we simply cannot take assets in those types of entities. But that's one of the facts that you'll want to talk. There's more and more of those at the state level these days, so it is something that comes up every once in a while. The other thing that we look at is our own tax risk. So another thing that comes as a surprise to folks is that in most cases, charities don't have to pay taxes on income that they make, whether it's a passive income like capital gains, etc. However, if we have an investment or an asset that is an investment in a pass-through entity like an LLC or even an S corp, we may owe taxes when we sell the asset. So we're going to assume the cost basis of the donor when we accept the asset. And if there is a capital gain, depending on the circumstances, what kind of entity it is, in most cases, if it's a S corp, we're going to owe some tax. If it's a partnership, depends on whether or not there's things like hot assets or acquisition indebtedness inside the entity. And so we need to know what tax liability we may have. So we have a way for gathering information from the donor. It's called unrelated business income tax form. We get the information from the donor, we give it to our tax group. They come up with an estimate of what we think we may owe, and we give that information back to the donor. So they can use that information when they're trying to decide what's the net proceeds they want to flow into the giving account. Because what we'll do is once we sell the asset, we'll escrow that percentage of the proceeds to pay our tax liability, and the rest will flow into the giving account. Now, having said that we have a tax liability, it's important to realize that that tax liability is going to be very much lower than what the donor would have if he or she were to pay the taxes on their own. We're able to take advantage of our own charitable giving. So our effective capital gain rate is about 8%. Our effective ordinary income rate is about 14%. And state taxes would not apply in most cases in a stock sale situation. We may have to look at state taxes in an asset sale situation. But, those are something that we have to look at because it's a cost to us for taking in the asset, but it's also something we work with the donor on to mitigate. So, the due diligence process kind of takes anywhere from 3 to 5 business days. It really depends on how responsive, counsel is with us working on the transfer. And, it's something that we can get done relatively quickly and efficiently, and it really does add a lot of value to your clients. I don't know, Leon, if you've had any experience in this or if you want to provide any more insight, whether it's your clients or your own.
Right. Well, I've had experience both of my own and with several clients, so I can attest that the Fidelity team does a remarkable job of doing it, and you did a remarkable job with one of my donations as well. The UBIT is pretty important. I think a lot of people don't understand that, and they don't understand that that's one of the key things coming out of a a complex asset donation of a closely held business is what happens with that UBIT transaction. And I've met a lot of CPAs. I teach CPAs in my non-day job, and when I'm talking to CPAs, a lot of them really don't understand how that works at all. Your team has done a great job of building up how to handle that kind of piece. I'm starting to see now, Lori, people taking even more design on the complex asset thing and doing things like charitable remainder trusts, flip cruts and nim cruts. I'm seeing some of that. And we just did a huge charitable lead trust where we got basically 100% donation by zeroing out the lead trust, where we gave a life estate in terms of there. I think if the capital gains rate changes, you and I are going to be so busy we aren't going to know what to do with ourselves. So I'll have to put all mine in the first tranche so you can take care of mine first before everybody else comes flowing in, because I think it's just going to be exceptionally busy. I'm really busy.
We're going to have some job security in the coming months, no doubt. But it is a good thing to be able to help people because, it's a lot of money that goes to the government that could be going to charities could actually get some good work done. So
true, very true. And the ones I see, usually the entrepreneur has almost a zero basis. So we're usually starting with an extremely low basis, and it's millions of dollars coming into their hands, and say, look, we can get rid of some of this capital gain tax. We can get this out of your estate. You can do some good things for the rest of your life. All the way around the horn, this can work for you.
Yeah, and one of the things that's great about working with someone like a donor advised fund or that's sponsored by a financial services company or something like that, is that we do have sort of the expertise around how to figure out the U-bit, and so we can try to help donors, miss those landmines, and making sure that they meet the right timing requirements and valuation requirements with the appraisals and everything else. So I think that, you as the advisor, add so much value. And then when you come to us, hopefully we can take the reins over and just do the operational part in the background, get it done. But the role of the advisor really is to identify those assets and have those initial conversations. So it's great to know what to look for.
Well, and it still can facilitate their intent. So I had a client that wanted to do a complex asset, and they said, I want to give it to my college. I said, your college doesn't know how to do this. Fidelity knows how to do it. Go to Fidelity and do it, and then we'll use donor advised fund and we'll do it that way. And actually, he ended up doing more of a contribution because he loved the idea of the donor advised fund. Oh, so I can use more charities. I can do other things later. And I said, yes. And if you get mad at your college because their football team's terrible, then you can give to another college. Or if your kids go to another college like mine all did, then none of them went to my alma mater. Now I'm donating to their colleges, which of course they're doing with my donor advised fund. So thanks. So anyway.
Yeah.
I can do some case studies. Jim, don't you have some case studies?
Well, let's move on a little bit. Let's take a look. If you think about your practice, sort of most of the work our complex asset group does is really focused on these four types. A lot of what we've talked about, we'll spend a little more time on the traditional business founder. Started a business 20, 25 years ago. It's grown up, it's successful. Now they're thinking about some sort of exit strategy. We'll take a look, we'll talk a little bit about executive level in publicly traded companies or companies that have recently gone public, sort of at the C-suite level around restrictions. We also, we love working with what we call the startup entrepreneurs, build a business, sell that one, go in for more, build another business, sell that one. It's not unlike the traditional business founder, but we see them repeatedly, and they're often in partnership with our friends in the private equity business, which you may have clients that are private equity investors or clients that are private equity professionals. Anywhere along that sort of pyramid of ownership of the LP interests, the GP interests, the side vehicles, all of those things have an opportunity for a charitable gift around some sort of liquidity event. Let's dial in real quick here and take a look at our traditional business founder. So here's Steve. He's going to be, everybody's practice has people like him. Started the business years ago, 60 years old, successful. The value in the business is their retirement savings or a significant amount of retirement savings. So the plan is going to be some sort of liquidity event. Leon, does this sound like the sort of clients that you guys have up there at Sequoia?
Sounds like me. This was me. I started my business 1989, grew it, merged with Sequoia. It was a thriving business. We're thriving, and I donated some of my stock in the transaction to my donor advised fund at Fidelity. So, Lori, thanks for doing a great job on that, and Jim, thanks for setting it up for us. So I got out of some of the capital gains and other things. This is probably my most common one we see. We see this all the time.
Let's take a look. Let's break one down here. Let's break this one down. There we go. Oh, we don't have the picture of her. Okay, well, let's just take a look quite carefully. You know, those of you that are financial advisors, this is the spreadsheet version. So if someone is selling their business, we got Stephen, he's going to sell his business. And in this context, we're going to sell the business for $10 million. And Steve is quite philanthropic and has met with his advisor, is meeting with his advisors, and is thinking about how to do a charitable gift. Column 1 is the normal course of events, where our business owner is generous, but our business advice ecosystem is saying something along the lines of, let's get the deal done, and then we'll make this charitable gift when the smoke clears. So our donor is thinking about a 20% or a $2 million gift in a pre-deal value. But they're thinking about, their advice is, let's just do it after the deal. So you drop down column 1, when he sells the business for $10 million, he's going to have 23.8 or just about $2.4 million of capital gains taxes that get paid. So the 20% gift after the deal closes is not a $2 million gift, it's a $1.5 million gift. So the donor takes a $1.5 million tax deduction. The university gets a $1.5 million, which is a fantastic gift, can't sell it short. All the way down at the bottom, after the charitable gift in the donor's account, $6.6 million on the $10 million sale in the charitable gift. Column 2, more like the planned giving department at your alma mater, Leon, where they know you're having a transaction and they say, well, why don't you give us $1 million in this big year and then give us $100,000 a year for the next 10 years. We'll name the economics chair after you. So in this context, our donor has given away the $2 million, but all of it after the capital gains taxes were paid. He's taken $2 million of charitable deductions, but a decade to do it, much of which in this example is in a lower tax bracket than the big transaction year. Drop to the bottom column, not correcting for growth, but net into the client's account, $6.2 million. Not a ton of savings by stretching it out like that. Meet with a complex asset group in advance of the transaction. Optimally, there's an opportunity for a 20% gift in equity. As Lori alluded to, we're going to become a minority partner in the business. Now our donor on their $10 million transaction has made a minority interest gift to the charity of 20%. So the donor's taxable transaction is not 10, but only $8 million. And the donor has made a $2 million gift to charity in fair market value for the equity given. Fast forward down to the bottom of the column, the charity puts the shares into the transaction, nets $2 million, charitable tax deduction, $2 million, including the larger gift to charity, net in the client account after the gift and the taxes on the sale, $6.8 million. So here in option 3, what we see is more for the charity, more for the donor, less for Uncle Sam. What's not to like?
Well, how about I add something sweeter in the pie? How about state income taxes? How about the fact that you pay capital gain tax, and in many states you pay state income taxes on capital gains as well. And by making the gift into my donor advised fund, if I'm in a high tax state, I get the state tax savings as well. And then probably tossing on that little tiny 96% tax increase under the American Families Plan, a $2 million gift would be $868,000 of savings by my rough math, not counting that state income taxes. So, we have clients in all different states, and one of my favorite states is Hawaii, but they have a 16.7% income tax rate there. Imagine that one. You're getting hit with 43.8 plus 16.7. I mean, pretty soon you're not really getting too much from the sale here. So
you might as well stay at work.
Yeah. So anyway, don't forget the state taxes.
Right. All right, the next one we see a lot of is executives at publicly traded companies who may have a piece or a significant piece of their compensation in some sort of equity program, shares, options, et cetera. Or you may have clients who started a business and now it is gone public. So they have some restrictions around what they can liquidate. And I'm going to defer to Leon and Lori here to talk a little bit about sort of the layers of what people get in equity comp and what's donatable. Lori, you want to jump in real quick?
Sure. So the types of assets we see from the C-suite executives who may hold restricted stock. Restricted stock is typically stock that is 144 restricted. Maybe the donor is a control person. We have a whole team of folks here who are able to work with counsel at the issuer to remove the legend when it's appropriate. Usually, if the donor has held the shares for a period of 6 months, they're not an affiliate. The publicly traded information is available. They're able to donate the restricted stock to us. We have a team that will take care of getting those legends removed, and we'll sell the stock. So it's very much like giving us clean shares. I think a lot of times people think, oh, it's restricted, it's going to be really difficult. There's going to be a lot of hoops to go through. Well, we know what we're doing when we get restricted stock, and we're able to take care of that on our end, and you're still going to get the fair market value deduction for restricted stock that is immediately saleable. So that actually becomes a really easy transaction. I think a lot of times people think it won't be, but it is. The other thing that we look at, people ask us about often, is they have restricted stock awards or they have options that are going to be vesting. Usually the awards themselves or the options themselves do not make the best gift to give. Oftentimes, regardless of who's holding that award or option, when those are exercised or vested, there's going to be an ordinary income tax event to the original, to the person who was granted the award. And that really can't be avoided even if we're holding it. So the best asset to give related to restricted stock awards or options is the stock, the actual stock that results from the vesting, and it's after it's been held for a year, and it's a long-term capital gain. So a lot of times we have sort of education with donors about what they can and can't do with their restricted stock awards or their stock options, and then hopefully once they know how it works, we get the same call back, and they're working with their advisor when that stock has vested and they've held it for a year. So those are the types of things I see. I also see people come when they know their company is going to be going public in the near future. Some people want to give the shares before they go public, which in some senses that you have to get the appraisal if it's the privately held shares and you're giving it, as opposed to giving the publicly traded stock, which the fair market value is going to be based on the trading. But oftentimes people are looking to do it before the public event so they can be anonymous and so they don't have any filing requirements and things like that with respect to that gift. So sometimes people want to talk about sort of strategically when and how to give the shares that they own. So I have seen that too.
I've played around with a lot of the C-suites. We get this, and we'll get the people taking the stock public. Obviously, that's the home run, is the one where you can donate the shares. We usually donate the shares right after the IPO or somewhere in the explosion range. After the explosion happens, everybody seems to think that they're going to have the explosion. One area that a lot of people overlook is NUA. I think that you got net unrealized appreciation in the 401k plan. So my executive here, she's got $1 million worth of stock that she's got a really low basis in her 401k. Take it out at the lower cost of market, it's automatically long-term capital gain. So we can kind of modify this. So what I see, again, Jim called it stacking earlier. We'll stack the C-suite executive. We'll say, look, you've got RSUs. Go see Lori on her group about what to do with your RSUs. Let's do this NUA. That's the easiest one to do. That's simple. We're going to get it out you're going to pay ordinary income tax on the lower cost of market. We're going to get the fair market value deduction when it goes down the pike, and we're still going to get we're going to get over to our donor advised fund or our charity. So that's going to be an easy one. A lot of stacking here, a lot of combining things, blending them together. And it's not one size fits all. It's let's figure out the right tool for the right job, open up the drawers and say, hey, let's do the NUA to our donor advised fund. Let's take the RSUs and hang on to those and exercise them. Let's take our other pieces there. Typically, by the way, Lori, I see it when they see the C-suites are retiring. They're leaving and they're going, I've got 45% of my wealth tied up in XYZ company stock, and you've been telling me for a long time I should have no more than 20. It's about time to diversify, and this charitable contribution, you've been talking about that. Let's do it. I like the idea.
Yep, absolutely. I see that fact pattern a lot too. A lot of times, to your point, this is where their money, people in this position, their money is concentrated. And when there's going to be a big liquidity event, it's kind of like the perfect storm. They're about to have a big liquidity event, a huge tax liability. They're totally concentrated in this stock. And this gives them an opportunity to diversify, get a tax deduction, avoid capital gains, and fund philanthropy. So the key is that I think a lot of times people look at and they say restricted stock. Well, there's no way you can give that. It's going to be a pain. It's restricted, right? So you can't give it. Well, that's not true. You can give restricted stock, and oftentimes it is the lowest basis stock that folks own. So you know, the key for you all is to know how to identify that these shares are there, and then we have the expertise to help you make them the perfect gift.
Yeah, agree.
Great.
So this is just a little, you know, I mean, as we've said, we've had a lot of success in our complex asset group. As you can see here, you know, we have converted over $8 billion from publicly traded, non-publicly traded assets into cash for people to use for their charitable giving. And even in just this past year, we've done over $400 million worth of illiquid assets we've converted into cash. So, and last year we converted $1.6 billion worth of complex assets into cash. So I'm very busy. I get calls every single day. We have the expertise here. There's 4 of us in our group. We support the nation regionally. And we usually work with, you know, we can talk to advisors if you have questions before you want to go and prospect your clients about what's in their portfolios. We're happy to provide that education, and then we're happy to get back on the phone with the donor. So this is definitely a popular area, and it's something that we definitely have the expertise to help you in.
So I would just want to iterate from being an advisor, you know, dealing with the right group of experts, having the right team is really important. Your clients are going to be wanting to hear about this. Your clients are going to want to know some of the tax savings. This is a great chance to collaborate, and it's a great chance to work with a solid team. I see many people who are charitably inclined who want to save taxes, and it's having somebody that knows what they're doing. In our case, we do lots of charitable donations, and Fidelity's charitable group is top notch. We're very happy with them, and I can speak from experience. It worked for me and was really well done for me.
Well, there you go. Thanks, Leon. Yeah, as you can see here, we do have a full team of in-field experts. Rumor has it we're back out in the field sometime soon, covering all of you guys across the country. There's 10 of us. And then Lori's team, in-house attorneys to facilitate these sort of transactions we've been discussing today. All kinds of resources and insights here at Fidelity Charitable to help you grow your practice around philanthropy. And then on the other side, we haven't mentioned them today, but they've come up in our series of webinars. On the other side of the charitable giving, we have layers of premium service for your clients to facilitate getting the money back out the door into the hands of the charities that are important to them and important to their families. We have research capabilities and a dedicated premium service team to help for your most generous clients to have the most impact out in the communities, which is really, in the end, what we're all talking about. So we have a few questions coming in. I think we have time for a couple of them. Here's the first one for Lori. Lori, is there a time frame within which Fidelity Charitable must liquidate a business interest received?
There isn't a time frame that we have to. Like I discussed previously, we're going to want to know that there is a liquidity opportunity in the near future. We have full discretion of the asset once we accept it. So we have a group of investment professionals that make the decision about how to go about liquidating the position. Obviously, you know, we're going to take into consideration the market conditions themselves. But we also have the ability, you know, if there is no liquidity event, or if the liquidity event is limited to sort of one option, one sort of sale that's on the table, oftentimes we'll ask a donor if we can get a redemption rate, which allows us to sell the asset back to the entity, not to the donor specifically, because for optics reasons, that's really not what the donor would want to do to protect the validity of the gift. But we would be able to put the asset back to the entity at a fair market value based on an appraisal. It basically is an insurance policy. It allows us to be able to have confidence that if for some reason the liquidity opportunity that we were planning on falls through, that a year from now we'll be able to put the asset back. And it also gives the donor, you know, some comfort, because the gift is irrevocable. And once the gift is made, while the donor will get the deduction, they'll never see any proceeds in the giving account for giving until they actually have a liquidity event. So, you know, making sure there is a liquidity event is key when you're working with your donors. And if there isn't sort of a plan B that's on the table, we'll most likely ask for something like a redemption right. And, you know, it's just important to know that once we have and own the asset, we do have discretion of when and how we want to sell it.
Great, great. Thanks for that. Here's another one on the publicly traded side. Are you able to work with charitable donations into a 10b5-1 plan?
You know, I have not personally dealt with that situation. However, my understanding is that, you know, a 10b5-1 plan is a plan that the donor has been asked to, you know, he or she is subject to by virtue of a request for the issuer. If they want to be able to sell, there's only certain windows that they can sell in and things like that. I believe that we are able to work within the confines of a 10b5-1 plan. Obviously, we would need to work with issuers counsel to understand what that plan is, how it works, and get their approval to be the seller. It really comes down to whether or not the issuer is going to allow for the transfer, allow for us to sort of be sort of the owner of the asset and subject to that 10b5 plan. But every case is different.
Absolutely. Just call us early and call us often.
Correct.
More of that story. And then here's that. I think that probably we have time for just this one last question for Leon. If you could summarize, what are the key things we should encourage clients to think about with their charitable giving this year with potential tax changes on the horizon?
I think a lot of people are looking at liquidity events in closely held businesses, and they're looking at trying to get them accelerated into this year for specifically that reason, with the hope that if the rates change, they'll be able to do something within the confines of the old rate versus the new rate. It's important if you're going to, when you're starting a discussion of a liquidity event, incorporate the charitable conversation early. Do it early. Don't wait until the deal is done. Get it before the deal is done that you know what you're going to go do, and say, look, if we do this transaction, let's do some of it to charity. Let's do some of it in this fashion. This is what it's going to save us. So again, planning sooner rather than later is probably the key thing. And I'm also, you know, I've got clients talking about, oh, I think the market's going to correct and whatever else. I go, then let's make a charitable donation now while it's high, and then we'll use that as a diversification event as well. So plan soon is my mantra for you.
Well, there you go, early and often. But I think we are about out of time here. I'd like to thank Lori and Leon for their insights and their perspective today. And thank you all again for making the time to attend today's webinar. Please remember to complete the webinar evaluations as we conclude today's event. And later today, we'll send a follow-up email with a recording of the webinar, the slides, and any additional resources around this charitable conversation we hope you're going to be having with your clients. Additionally, don't forget, we will submit CFP and IWI credit directly with the information that you provided with your registration. And of course, remember, Fidelity Charitable is always here to help you make charitable planning accessible, simple, and effective. We hope you will reach out to us for charitable planning guidance whenever the need arises. Have a wonderful afternoon.
Thank you all.
Thanks, everyone.